This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. And Joe, big rally last week. S&P was up 6%, had a good week for bonds. But I'm curious, was all that because we got the CPI report, or was it something else?
Well, that was really the only, headline news that we got. I do find it interesting that non-U.S. markets actually outperformed last week, but that's because the dollar was down. But it does make me think that maybe there's a little more to it than just a better CPI report, because it was so broad-based. Really, markets all around the world were up. But look, I think that in a way that may make sense. The Fed's policy does have an impact on a global basis, so we'll see. I would say that at least with respect to Europe, that we are seeing, I think, some positive movements there. Because of what happened in Ukraine with Russia backing off. I think that certainly got something to do with it. So maybe there's multiple factors that kind of came together in 1 week, and the CPI was just the catalyst. Now,
you're a student of history, so I'm going to let you put your professor hat on here for a minute, and I want you to compare what was going on in the 60s and 70s in that inflationary period with what's going on today.
Yeah, I've been looking at these periods because I think that I'm not sure it does a lot of good to look back to the 90s, for instance, or the 80s even, when inflation and interest rates were coming down rapidly, to look at some kind of analog, something to compare to kind of get an idea of what to expect. Because that's not the environment we're in. We're in an environment where rates are rising, inflation is rising, or has been. Maybe it's peaked. So I look back at the 60s and 70s, and in those 60s and 70s bear markets and recessions, stocks tended to bottom somewhere near the time that inflation peaked, which would kind of work fine for right now, because it looks like that inflation peaked in June. You've had 4 consecutive lower readings since then on a year-over-year basis. We've had some more recent month-to-month has been on the way up on the headline CPI, but overall CPI year-over-year readings have been down for 4 months after that June peak. So inflation may have peaked, and that's great. Except, and it looks like stocks have bottomed. We made that low in June. We undercut it a little bit on the S&P in October, but basically we put in some type of low here, some type of bottom. The only problem is that if you go back to the 60s and 70s, those bottoms were made when the economy was already in recession, and we're not there yet. And so it gives us a little bit of a conundrum here, where we've got inflation has peaked, but maybe interest rates have not. We're not sure about that. I would also say, too, that in those previous episodes, the Fed was already cutting rates when stocks bottomed. So there's a number of things here that are different, and I'm trying to reconcile how we're going to get from here to there. If we really have made a bottom and stocks are going to go into some new bull market, it begs the question then, does that mean that the yield curve is wrong? Because the yield curve says we're going to have a recession sometime next year. Now, it could be that the lead time to recession is a lot longer. Maybe it's 18 months. We've had really long lead times before that's happened. It's possible we get a bull market before we get a bear market for the next recession. I'm not sure. I just know that the exact conditions today don't exist like they did in the 60s and 70s, except for the fact that inflation may have peaked. I suppose there's the possibility that the yield curve is going to be wrong. The 10-year 3-month has never inverted and not gotten a subsequent recession, but there's a first time for everything. So I suppose it's possible. It doesn't seem likely, but it is possible, I suppose. The only other thing I can say, like I said, is maybe there's a bull phase before you get to start discounting some recession that's going to come 18 months from now. That's possible, I suppose. But like I said, look, we don't predict the future here. We just take things as they come. What I would say right now is that the market is trying to make some kind of bottom here. It is obvious from looking at, from a technical standpoint anyway, that stocks are trying to make a bottom. So is that going to be something that's, turns into a bull market? I can't tell you that. I don't know.
Well, talk to me about that shift last week in the 10-year Treasury and the dollar. They both seem to break at least a little bit that uptrend they've been on for a while.
Well, we did break the short-term uptrend in both, and that seems to be a big deal. Certainly the market this year, the stock market has responded two interest rate hikes, two higher rates. That's why stock came down. So when rates come down, stocks can rally. It's just no more than just a standard discount rate model where if the discount rate goes up, the valuation has to come down. So rates peaking in that way, breaking the short-term uptrend, and the dollar breaking the short-term uptrend, those things are obviously related. So I think that's, it's a short-term uptrend though. The intermediate to long-term trend has not changed. But, we were so overbought on both that you could come down a lot on both and still be in an intermediate to long-term uptrend. Just to take rates, for example, you could probably pull back to the low threes, 3.25, something like that, and still be in an uptrend on rates for this cycle. On the dollar, you could pull back to the dollar index, you could pull back to 100. I don't think it's going to quite go that far on this move, but you could pull back that far and still be in an uptrend. That's how high they had gone, how fast they had gone up. That's how overbought they were. So look, the short term, we don't make big changes based on short-term trend changes. We're looking for long-term inflection points. I don't think we're quite there yet. So I wouldn't say that this is going to trigger any kind of big changes in the portfolio. It may make some smaller changes. But generally, if you have a short-term trend change, what you want to do, if you're going to trade it, you want to make small trades with a tight stop in case you're wrong and it reverses, because short-term trends don't really mean all that much.